In this lecture, we will cover the CFA Level 2 reading on changing investment objectives. This particular reading is based on the actions of Mitchell Hutchins Asset Management Company. Mitchell Hutchins commenced management of the PaineWebber short-term US government income fund, henceforth referred to as the fund, in 1993, marketing it as a higher yield and somewhat higher risk alternative to money market funds and bank CDs. The prospectus disclosed that the fund's investment objective was to achieve the highest level of income consistent with preservation of capital and low volatility of net asset value. The appendix to the prospectus also disclosed that the fund had no present intention of investing in certain classes of interest-only and principal-only stripped mortgage-backed securities. However, contrary to the fund's low volatility investment objective and no present intention statement, the fund's portfolio manager began investing in certain interest-only and principal-only securities in the fall of 1993. And notice that this is just shortly after the initiation of the fund. When interest rates increased sharply in February 1994, the fund incurred significant losses, performing well below comparable funds. The SEC sanctioned Mitchell Hutchins for the failure to trade securities for an investment fund within the limits of the stated fund objectives. So this is a straightforward situation. It was clearly stated that the fund is going to invest in low volatility instruments and actually made it clear that it would not invest in certain classes of IO and PO mortgage-backed securities. And then the fund went and did exactly what it said it is not doing. So obviously this is a violation. So what does the CFA Institute say? By investing in securities outside the fund's stated objectives, the portfolio manager's conduct violated Standard 3C, which has to do with duties to clients, specifically in the context of suitability, and Standard 5B1, communication with clients and prospective clients. Standard 3C.2, which has to do with suitability, states that when members and candidates are responsible for managing a portfolio to a specific mandate, strategy, or style, they must also make investment recommendations or take investment actions that are consistent with the stated objectives and constraints of the portfolio. So that was not happening in this case, which would be a violation. Standard 5B.1, which deals with communication with clients and prospective clients, states that members must disclose to clients the basic format and general principles of the investment processes by which securities are selected and portfolios are constructed, and shall promptly disclose to clients and prospects any change that might materially affect those processes. And this again was not happening in the case that we are talking about, which would constitute a violation. How can CFA Institute members ensure that they abide by the principles of the two standards that we are talking about? And here is what is recommended. Number one, when managing a separate portfolio, members should make a reasonable inquiry into a client's financial situation, investment experience, and investment objectives. This information should be updated at least annually. Number two, members should disclose the basic format and general principles of the investment processes by which securities are selected and portfolios are constructed at the outset of the relationship and on a regular basis thereafter. Number three, Members should implement regular internal checks for each account to ensure that portfolio characteristics meet the account's investment mandate or the stated investment strategy in the case of pooled funds. And finally, if members wish to change the investment objectives or strategies of portfolios they manage, then members must notify clients and investors of the potential change. Members should fully disclose the impact that the change will have on the portfolio and secure documented authorization of the change in strategy from the clients. That is it in terms of this short reading. The quick point is that when a firm declares its objective in the prospectus, then its actions should meet what the prospectus is saying.